Now we want to talk about inflation and CPI. So we've been very much on the going about that inflation was very high and it's going to stay high and it's being undercalculated and we're seeing it everywhere, but they're not willing to admit it. And now we saw it blow through estimates. So what were the estimates? The estimates were broad in terms of just what they were expecting. And I'll just pull up in general what they were, because it came in at about 0.77%. So the we rounded up to 0.8. So the expectation for month over month was 0.2. Came in at 0.8. Now I can talk about year over year, which is fine. It exploded. Year over year was expected at 3.6%, came in at 4.2%, but we had a very deflationary event. So again, we should see inflation go higher. Clearly, it went higher than expectations, but more important is the month over month. What is the trend? Is the trend up? Is it slowing? Is it getting better, worse? Well, it's getting worse. And when you look at the headline CPI, because I think this is the one that matters the most, because everybody wants to blame energy. Energy was down in April. March into April, energy was down. It's going to be up in May. It's going to absolutely be up in May. It was down in April, and we still had 0.8%. So now let's look at household furnishings, up 0.93%. Motor vehicle and parts, used cars and trucks, up 10%. If you watch the previous segment, that is not stopping. We do not have these assembly lines coming back aggressively to meet this demand. There is a shortfall on inventory, which is going to keep that well-supplied, well-bid. Recreation commodities up 1.2%. Education and communication commodities up 3%. Again, that's something that won't continue at that level, but still remain elevated. Shelter. When you look at lodging away from home at 7.6%, that's because hotels, people are getting out more, they're doing more, you're getting more pricing overall. But rent of primary residence is only up 0.2%. It's still going higher, and it's expected to go higher, and we're going to see it continue to go higher. Airline fares up 10%. People are flying a bit more. Still less, they're trying to make back some money. So there are things that are going to mix in terms of what is driving, what is not driving. Food is only up 0.38%. That's going up again between April and May. Because what are we seeing right now? We're seeing, and for those that are in the market, are May prices lower than April prices? Have you seen a reduction in prices? No. They're continuing to go up. They're not even holding flat. They're going higher. So what are we here? What is the pushback? Oh, it's transitory. Okay, well, what is transitory? It is now deemed 2 years. So something that's transitory over the course of 2 years, so we should ignore the pain that we're experiencing for that 2-year time horizon, because everybody keeps pointing to, well, we have so many savings. So if we have so much savings, and we've blown that out of the water multiple times in terms of where that savings resides, but okay, there's more savings. So more savings means that people buy more, which then increases the velocity of money, which then increases inflation. So no matter where we go from here, whether we get a strong demand response, supply chains, we are going to get essentially what is going to be a worst case scenario of if we get a strong demand, it means you're going to get a lot of velocity of money while supply chains still remain impacted. So this is not going to end well. This is not stopping. This is not something where we're going to turn around and say, wow, I'm surprised May's isn't as bad as we expected. Clearly the individuals who come up with these estimates live under rocks, because the spread was between 0% to 0.4%. I want to shop where they're shopping, because clearly what I'm seeing and what is here, I'm still seeing something higher. But again, this is a basket. We're looking at what is the basket saying, and clearly the move is up. So now let's say, okay, well, what does that sticker shock look like? Now, this is just some prices, popular foods overall. So remember, food is only up, based on the April CPI, food is only up 0.38%. But yet, when you look at some of these key things, they're up over 5% and as high as almost 20%. And it's a change in unit price. Now, this is year over year. I get it. What I was talking about is month over month. But where do we see this getting better? Where, like we in the EIA show, we talk about trucking, we talk about diesel, we talk about gasoline. This stuff moves on a truck. This stuff moves on a boat. Those prices are not going down. They're going higher. The supply chain remains strained. So this is not something that's going to just disappear overnight. So when we look at the U.S. core and headline inflation, now core CPI excluding food and energy, month over month, and then the month over CPI month over. So you're seeing that core pieces, obviously food and energy are important, but the underlying data points are telling you things are worse, because then when we add back in food and energy went down. So we know it went up. We now have the Colonial Pipeline issue, which is going to reverberate through at least the end of May into the beginning of June, also impacting where this inflation expectation is going. But it's also a failure in a sense where if prices stop going up, they might say, well, inflation is over. No, now we have stagflation. Now we have the issue where prices still remain elevated. Yeah, they may not be going higher, but whose wages are going up? We're going to talk about employment and what does that mean? The issues are going to remain impactful throughout a long period of time. Let's now look forward a bit. Let's look at a trend model. So this is from Macro Bond and Nordea. So the U.S. CPI year over year is down here, but the trend model, when we take in U.S. dollar, ISM, ULC, food prices, and flat oil, this is where we're going. So to give you an idea of where this tracks, this is not something that is going to end. Now, given it peaks, I'm not saying this does not peak. I'm just saying it's not going to come back down once we get to that point. So people are still going to have that pain at the pump, at the food store, and it's going to hurt just general consumer demand. So let's look at this a bit differently. USA core CPI and FIB. So the small businesses. So when we look at actual price changes adjusted for gasoline prices. So when we look at where, and we have charts on the NFIB, prices are going higher, and this is without wage increases. So they've talked about how, the NFIB has talked about how there haven't been wage increases. This is all supply chain. This is all some of that shortage in inventory. Now they are struggling to hire people, so that means you have to pay people more. How much of that price or additional cost can get pushed through the system? And is this going to lead them to say, look, I can't afford to pay you $20 an hour. It has to be 15 or 14 or 13. And people are like, well, I'd rather sit at home and collect a paycheck, or I'd rather get a different job, or I'd rather wait and look for something else. And again, this is where we're seeing the stickiness with the unemployment and not getting back to work. So let's take this from a different perspective. The U.S. City U.S. Inflation Surprise Index and the U.S. 5-year. So yields have finally started to react. We're finally starting to see that long end of the curve, longer duration coming up, and seeing that pressure when we start looking at bonds and rates in general. We don't have it in this show. We'll have it on the Friday show because we want to let some of this settle down, and then we'll start looking at where did the yield curve shake out. So now when we shift a little bit further, down, I'm just looking to make sure I'm on the right page. So when we look a little bit further, import strength. So let's look at products with the greatest percentage increase in U.S. imports: footwear, fuel oil, petroleum, semiconductors. All of these things that we're continuing to import all have raw materials that have gone up, are all subject to the strains in the supply chain. So when we look at the greatest percentage of increase in U.S. imports from February to March, are semiconductors going to get any better? Well, no, because we're shutting down supply chains because we don't have enough. So there is more pressure that continues, and this is going to pull even more of that into the U.S. in terms of those price increases that are just going to continue to get import. Because for so many years, for 20 plus years, we have exported inflation. Now we are officially importing inflation, and these are just some of those examples. So then when we look at pandemic emergency unemployment assistance, so this is breaking down what the regular unemployment benefits are in terms of that blue side, and then the extended. We're starting to see states reject or turn away some of that federal benefits to try to get people back into work, to accept, a lower wage job. And we're starting to see that more and more. And I think as you see that accelerate, the government is going to turn around and say, okay, well, maybe now it's time to reduce some of these assets and have that expiration date actually come to fruition. Now, there's a mixture of, is it actually causing an issue? Because when we look at the wage percentage, so average wages actually came way down because we did get an increase in low-level employment with lower wages. So when you look at the numerator and denominator, if the denominator itself gets bigger because more people went back to work, but the numerator or the hourly rate goes down, divided by a bigger number, you are going to get that movement lower. So we actually did get more low-level employment. It's not the wages that people are expecting, which is, again, speaks to the wage problem that continues, because a lot of these individuals in some of these other states, you can't look at that and say, well, in South Dakota, they're just getting extended benefits. Well, they're not. And this is what is being limited. So we're seeing some of those changes in general, which I think is an interesting data point when we look at it overall. And the beverage curve continues to show it. So high openings, high unemployment. As we said during the whole lockdown, we did not get job opening rates go down. Now they went sideways as the unemployment rate exploded out, as people went furloughed, but the job openings never declined. Now we have job openings at near record, if not record highs, but yet people aren't going back to work because the wages aren't there. But then when you look at the company, what is that ability the company has to pass on higher wages? It's very, very limited. So now this is just looking at latest for March with unemployment rate adjusted for drop in participation rate. So clearly you can see that there is still an unemployment rate problem, but where is it going to get fixed? Because people still are not willing to go back for the wages that they're seeing. And this is just showing on a different level, going back to December 2000, you can see the job openings rate is very high. It is elevated, it's there, and we're just not getting people back in the office. Now, but working from home dropped in April. So the percent teleworking or working from home because of the pandemic all was down to 18%. So in January, we were at 23%. We're now at 18%. And if you look over the last 3 months, we've gone from 23% to in February, 23% to March at 21%, now at April at 18%. How is this not the reopening? How are we, this in May of 2020, we were at 35% of the people working from home. By October, we were at 21%. Why? Because states opened. There are states in the U.S. that have reopened already. So this grand reopening scale, I think, has to be weighed against that. Management and professional, 57% May of 2020, 33% in April. We're seeing acceleration. So in December, it was at 42%. Now it's at 33%. That's not a reopening. Like, how much of this becomes sticky because of flexible schedules, permanent work from homes? These are the things that are going to continue to weigh on that total consumption and consumer demand that is shifting the way we're consuming and purchasing goods. So let's look at the pandemic jump, because everyone, let's look at rents in general. So the median monthly rent for available properties was $185 higher than a year earlier in the first quarter of 2021. Now you have people that are coming back to work. You have rents coming up. Now remember, when you put in, when they do the surveys of how much are you paying in rent, from a landlord's perspective, if you don't know what you're going to receive, you say there's an option for I don't know. The system obviously can't process, I don't know, so it defaults to zero. So you have rents that have been skewed to the downside, even though rents are going to go back up or at least stay at the levels that they have been. So you're going to get this big move higher. And when you look at just the cost of living, when you look at the home prices, all of that is drifting up, which again is going to pull all of these factors higher. Consumer expectations. Americans expect rental prices to jump by more than 5% this year. Again, speaking to what they're seeing on the ground, because you're going to get that, the federal judge just said that what the CDC did with foreclosure and eviction notices being postponed isn't legal. So that means that you're going to have to start paying your rent. And if you don't, you're going to get evicted. But what was your rent at? Is it going higher? And that's why I think you're starting to see people accept the fact that rents are going up. Now let's look at the NFIB. So the Small Business Optimism Index. Plans to increase employment was down a bit. Plans to make capital outlays started to go back up. And expected economy to improve came down again. So there's a mixture of, are you going to hire more people if you're concerned about the economy recovering? So if you think your sales have peaked, you've already passed through pricing, are you going to turn around and hire new people? And the answer is no. Now, plans to increase employment is still positive. It's still in the positive level, but it's slowing. And I think that is a bigger issue in general in terms of where we continue to see some of these pressures. So now when we look at the compensation index, it's still not back to where we were in 2020, but it's back to 31. Now, small business compensation plans is still very much depressed, or at least coming back to 2020, but it was still low to begin with. And it's only halfway, or let's just say maybe 70% of the way back. To get above that, back to the 25, 26% is going to be difficult if you can't pass on some of these cost increases, which is why when we look at small business higher prices, you can see that they're going back to 2002, all-time highs. Price plans of the next 3 months, they all plan to raise prices over the next 3 months because they're seeing what's in their supply chain and they know prices are going higher. So that means that they're going to pass through as much as they can before the market tells them that they will not accept anymore. And employment up in April in low work from home sectors. So the low work from home sectors are the ones that came back. But again, these are the lowest level or the lowest paying jobs. So we are seeing jobs come back, but at a lower level, which again, these are individuals that don't have the ability to spend, that will get pressured by $3 gasoline more than most, which is going to limit the amount of activity that we're going to see within the market. So then if we look at empty positions, firms across industries say they're experiencing labor shortages and skills mismatch. The skills mismatch is at some point, the company and the person, the employee, is going to have to recognize that there is a mismatch. The employee will have to recognize that they're going to accept less, and the employer that they're going to have to be less efficient while training. Until that marriage happens, we're going to see this big disconnect remain in the system. And then taking this to the next level, U.S. personal consumption expenditures, goods have moved up. But when you look at services, we're still not back to where we were pre-COVID. So even if we get goods pulling back, which we will in terms of pricing and expenditures, services still has room to catch up. And when you look at price push through and recovering some of these prices, we're still going to see that accelerate and that pressure continue to come through, which again is why we think that there is still upward momentum, specifically in the inflationary categories, that this is far from over. So now that we've touched on that, we're going to go deeper into the job side and why that continues to disappoint in terms of estimates and where we think things are going to shake out over the medium term.